In this video, traders, I want to talk about an unusual chart pattern that's got quite a good risk-reward ratio. Not your typical stuff, but I think the risk-reward ratio makes up for the quality of the pattern. Stay tuned. Hey guys, warm welcome to you. All right, so, we talk about traditional chart patterns all the time. Bull flags are some of my favorite things. Bear flags, if we ever get kind of big sell-offs, I love bear flags. Some of the most profitable patterns with the urgency of the sell-off and all that kind of stuff. We talk about the first pullback, all these other good, solid chart patterns. But there's something I've been noticing recently in a lot of different stocks, some of the IPO stocks, and also, we get it from time to time in markets. And I've always, kind of been drawn to these patterns, even though they kind of go against my whole theme of supply and demand. But really, when you drill into it, it's not so different to how you normally trade. But what I like about these is the risk-reward ratio is extreme. 10 to 1 plus. And so really, even if they don't work very often, which, honestly they don't, it's not a 50-50 trade, it's probably maybe 30% of the time they work, or 30% of the time you're going to get at least some of the table, and then maybe 20% of the time you get the big kind of 20R moves. But the point is, it still potentially can play a part in your trade ideas, your trading arsenal, trading setup arsenal. So this is kind of, imagine this chart here. We've got a kind of move up and a big heavy down move, right? Big heavy down move. And normally, traditionally, you kind of say, well, you know what, we're kind of bear flagging at lows, maybe, or it's a downtrend, and fine. That's probably the right, and in fact, if you played the short side on this, that is probably what will give you the most profit over time from a probability perspective. Now, risk-reward ratio is a little bit skewed when you're this far down in the trend. We'll talk about that in a moment, because how much more have you got? Where do you kind of allow for the bounces? Especially when you're late to a downtrend, the bounces can be quite brutal. Especially when you're talking about an individual asset rather than a currency pair, because currency pair is slightly different, of course, good trading one against the other. But if you're trading an asset that's been battered so much, you've got to be careful of these snapbacks. And if it's a stock, that can double before it halves again. So anyway, imagine you've got this scenario, and let's say, I don't know, a moving average is kind of like this type of thing. So if you like you kind of see distance from moving averages, maybe this helps to visualize it. So you've come down a long way, and the parameters have got to be this. This trend here, you've got to see multiple pullbacks. This does not work, and it's absolutely a bear flag if you had a kind of move lower and then you're getting this, and it's sort of the first consolidation. The springs consolidate because the springs kind of stretched and it's kind of contracted back again. Then that is likely to resume, and I would always position myself, if I wanted to, on the short side of that, because it's the first move, the first kind of move into fresh territory, into lows with a catalyst, etc. Fine, it looks like it's about to go lower. But when you've had prolonged trend to the downside, and let me just qualify this slightly. Ironically, you don't want too much of a long trend to the downside. You don't want something that's completely fundamentally broken. Maybe it's a company that's just looking dreadful for years and years and years, a long-term downtrend. No, that's a slightly different scenario. This is more the case of, okay, we've just had an extreme down move, but generally, it's not so bad. Maybe it's an IPO here, maybe it's come down from a big kind of move over multiple years here. So you want some underlying strength. You don't want a company that's going bankrupt. That's a different setup altogether. We talked about that previous videos, some of this bankruptcy pop, if you like. But something where you've had extreme down movement and you've had it for a prolonged period of time. So you've had, I like to think of phases. So you've had the spring stretch, contract, and every stretch tends to be a little bit less. The first move is big, second move a little bit less, third move tends to be a little bit less again, and the unwinding takes longer. And that's why we do that first pullback, then the second pullback's deeper, the third generally kind of consolidation range chop before it resumes either to the upside or to the downside. So you've had a prolonged move. That's got to be the kind of parameters. In not a completely dead market or stock, and then you kind of see, okay, this feels stretched. Your stochastic's going to be oversold, your RSI is going to be oversold, all the indicators are going to be oversold. Fine. You've had the duration of time where buyers have kind of fed up of it. Anyone who's looking for anyone who's sort of buying this pullback here is gone. Anyone who kind of feel like they're adding, they're gone. So the shine's gone off the market completely. But then when you get to a point here and it sort of just sits there, and volume You know, if you can imagine volume's normally, I'm just going to draw a line rather than a bar here. Your volume's called peaking. It really peaks as it goes down. Then it, you know, it's very low. It's just tapering off. And this is what you want. You want to see where no one really cares what's happening to this stock or this market, and it's gone off. And maybe had a lot of shine and a lot of kind of people hyping about it when it was up here, and now it's gone. And it gets to a point where you just see it finding some support. And yes, traditional TA will say, well, it's a bear flag, it's a bear flag. But this is, again, kind of going back to the stuff at the beginning, it's just subtly different because the length of it, the duration of the move, the fact that it had a bit of shine up before, the fact that it's underlying, it's not completely bearish. It's not bullish by any stretch of imagination, but it's not like it's a stock that's come down from, you know, $500 to $2. Different story. Or maybe you could play it, but let's stick to this for now. When you see this, you know, this is when no one's watching. And when no one's watching, then there's opportunity because everyone's done and gone and gone. But the reason it's finding support there is probably because someone somewhere with a reasonable size fund is saying, you know what, this now presents some value. Maybe it's half. This now presents a bit of value. We could get a doubling from here quite easily. And you know what, it feels like it's a good place to buy. And it sort of goes under the radar because no one's looking at this. But if you spot these type of things, you can say, you know what, maybe there's a trade here. And going back to the kind of thing I mentioned at the beginning, yes, the chances of it going up are, you know, probably less than 50-50, but because you can literally put a stop under your low here, and your target is either at your moving average or even half the move, or, you know, you're really getting some exceptional risk reward ratio opportunities, but you've got to be prepared to take your medicine and say, hey, you know what, if it doesn't work, then I'll leave it and not kind of try and finesse it and try and get in or add to the position. But the key, what you want to really see is to find some support, volume drying up, even better if you can find it, I'm using my black pen, if you can find it so that it just kind of tickles through a few times and so it does a few little wicks and holds. Now, like I say, this sometimes technically is this the best thing to do? No, but trading sometimes isn't all about the textbook stuff. In fact, it's not really. It's about finding the opportunities that present a good risk reward ratio. Preferably, you've got a good probability of success as well. But hey, the point is when you've got 20 to 1 opportunity or 10 to 1 or even first scales or 4, 5 to 1, then it doesn't have to work for you a lot of the time and it's going to be a profitable trade. Do you get these often? No, they're not frequent, not the sort of thing that sets up every week. But I noticed a lot of them coming over my screens recently, and I thought, you know what, taking a few of them, I thought, you know what, these are pretty good because no one's looking at them. You found some support. There's a definite area for your stop. The chance of it kind of popping and giving you a multiple risk reward is high, and you know they're kind of worth a shot. And it goes against what everyone's doing, and I like that kind of stuff. As long as you can frame your risk, when you trade against the crowd, as long as you can frame your risk and you don't get suckered into the idea. In the day, this is the key thing as well, guys. If this carries on going lower, you leave it, you move on, you never look at it again. Or maybe look at it again further low, but you don't try to say, oh, I think it's long, going to miss it. Don't fall into that trap because you just undo all the hard work. So whenever everyone's kind of not looking at something, market's got hammered, and it starts to find some support, volume has dried up, it's had a big move, the story is reasonably okay, still behind the market, then hey, risk reward ratio is fine for a price action trader like you to go, you know what, I'll have a little trade there. I'll see what happens. And if we go advanced, maybe you take a very small size and then you use that and start to add to the position of scaling. Be careful though, because if you're on a downtrend, what happens probably more than hitting your final target of here, whatever it is a retracement back. Some good volume comes in because it starts to suck everyone back in again. And then really if the fundamental story is a bit rough, it starts to roll over. So be careful chasing too much. You really want to be this kind of the second person who's taking the cheese. First, guys, is the person sitting there finding the support and showing the support in the chart. You then step in. You really want to be feeding it to the retail guys who start to pick up the hype on this stock. Oh, so-and-so is recovering. That's when you want to be feeding your stock out into them and selling it into them. And hey, if it carries on higher, fine. Maybe you keep a little chunk on. But if it rolls lower and they get burnt again, great, you've scaled out a position. Anyway, guys, unusual chart pattern, but I think a great risk-reward ratio. Take care. See you next one. Bye-bye.